Welcome everyone. In today's video, we're going to take a look at how to short sell any token you would like using the power of DeFi. Now we're going to take a look at decentralized perpetual futures dexes, money markets, and leveraged yield farming. With the recent collapse of FTX, a lot of trust with centralized exchanges has gone. The classic advice of not your keys, not your crypto has rang louder than ever, and now it's time to get off of centralized exchanges. Now, the first thing we're going to talk about is decentralized perpetual futures dexes. So places like DYDX, Drift, Perpetual Protocol, that sort of thing. You can use any one of these perpetual futures dexes to go ahead and short a myriad of different tokens. Now, DYDX is one of the best places to go. They have over 38 different markets that you can trade on. Ethereum, Bitcoin Curve, Polygon, Solana, Dogecoin, and most of the economically relevant coins out there. So you can go ahead, check out the website and scroll down this list as to see which markets you can actually go ahead and short sell if you want to. Another added bonus of actually going ahead and using DYDX is that all of the trades there are gasless and they feel most like a centralized exchange experience. Additionally, you get trading rebates for actually trading on their platform in the form of DYDX tokens, which are distributed to you at the end of every month. You can go ahead and short sell any token you would like on DYDX by clicking on trade and then choosing which order that you would like to actually go ahead and sell at. I'll just choose a market one here. You press sell and then you can choose which market that you'd like to short as well. So if you wanted to execute an Aave short, you can just click on this. Or if you wanted to click on a Litecoin short, you can go ahead and press that button there. And then you can type in the amount of Litecoin or USD that you would like to short sell. And then you just press this button down here and then you'll be able to go ahead and short sell anything. I'm not currently logged in, and so that's why you can't see this button here being highlighted as green. You can use any leverage yield farming platform like on the various different chains out there. So like Taro and Phantom, for example, I'm sure you'll be able to do something similar. So why would you want to use a leverage yield farming position to short a coin? Well, there's two reasons, right? A lot of these tokens have hyperinflationary tokenomics similar to like the Zimbabwean dollar. So they'll be releasing a ton of tokens out there and those are just going to get mercilessly farmed and dumped. And you won't be able to short a lot of these tokens on centralized exchanges. Maybe they just don't offer it. Two, you might not be able to short it because you're from a restricted jurisdiction and maybe you don't want to go to a shady centralized exchange. So there's a way you can do it through a DeFi ecosystem and you can structure a leveraged yield farming position in order to actually short this particular token. The max leverage that you can get, it's about 50% of your portfolio being short any particular asset. It's just the way that you can use Francium and Tulip. You can only use 3x leverage. So if you could use more leverage, then you can, get a larger short position. But for now, there's only 3x leverage available on these two platforms. So just to note, you can only short sell anything that is available to borrow. If you cannot borrow the token you want to short sell, then you won't be able to do this strategy. So on Francium, you can check out which ones you can actually borrow by going to the Lend tab. So we have like MSOL, Sol, Bitcoin, ETH, Ray, BNB, Uni, Sushi, Serum, Atlas, Polis, Orca, Samo, Gene, and DeFi Land. These are all the coins that you can short on Francium. They have a great calculator feature here, which should be able to demonstrate what's going on in a visual way. So it would help you understand what's happening. So we're going to set up this farming calculator in a certain way. Say, for example, you're bearish Solana and you want to short it, but you only have USDC on you and you want to do it through a leveraged yield farming position. So we change this to Sol USDC. The leverage needs to be 3x and the asset to borrow has to be Sol. So let's just change this to a 30-day time period. So this is an equity curve for your leverage yield farming position. The blue line is if you just held Sol and without farming. So you would still have 100% of your Sol, no matter what happens to the price of it. I mean, like one Sol is one Sol. So it's, your equity percentage stays at 100. However, once you open up a leveraged farming strategy, this is what the green line is. We can see that you actually make money as the price of Sol goes down. So for example, if the price of Sol went down 40%, your equity is now 118%, meaning that you made an 18% gain due to the fact that the price of Sol went down 40%. I mean, this is at the end of 30 days. If we change this, the P&L curve changes a bit, but I think that it doesn't really make sense to hold a short position too long, especially in crypto, because we can get very volatile situations and you can potentially get liquidated. Like if the price of Sol goes up 61%, then you can get liquidated. But yeah, like I said, like say if the price of Sol went down 20%, you actually made 15% on your short position. However, once you go like sort of past 50%, your position is no longer a short and you actually start losing money the further you go from a 50% drop in Sol. So if you were going to do this, as soon as like the price of Sol dropped about around 40-45%, you'd want to close out the position and then reopen it again if you were still bearish Solana. This is what the leverage yield farming short should look like on a graph. But now I'm going to show you all the figures behind this and really walk you through exactly what happens when you are opening up a leverage yield farming position with 3x leverage, but you're borrowing the asset that you want to short. So don't pay attention to any of this stuff for now. I'll explain it. What I want you to pay attention to is my cursor here. So let's just say for the sake of this example, we have 100 USDC and we want to go short Solana and we want to do it through leverage yield farming. So you don't have to do this on Solana. You can do this on, like I said, any token that's available on this Francium lending tab. But I think it's just easier for me to show you with Solana because we're all familiar with like Solana's price and it'll be easier to just visualize in your head. So you want to go short Sol. So you leverage yield farm the Sol USDC pair at 3x leverage and we'll be borrowing Sol to do so. So you have the option to either borrow Sol or USDC. If you borrow USDC, then you're entering a leverage long position. But if you're borrowing Sol, you're going to be entering a short position on it. So make sure to be borrowing Sol. So for the sake of this example, the price of Solana is going to be $200, so it's going to be $200 per Sol. So when you're leverage yield farming Sol USDC at 3x leverage and you're borrowing Sol, what happens is that you borrow an additional $200, which is going to be 1 Sol because 1 Sol is $200. So your total farming position then becomes $300, and that's made up of 1 Sol and 100 USDC. But in order to farm the Sol USDC pair, you need to have an equal amount of each asset. So 50% of your portfolio will be Sol and 50% of your portfolio will be USDC. So your Sol is now $150 worth instead of the $200. So that's 0.75 Sol. And the other 50% of your portfolio is now $150 worth of USDC. So in that example, you started off with 1 Sol and then it turns into 0.75. So what happens is that 0.25 Sol is then converted into 50 USDC, and that with your initial deposit, makes up the 150 USDC that we see here. So when you want to close your farming position, you will have to return that 1 Sol that you borrowed initially. But that 1 Sol has been split up into 0.75 Sol in your farming position, and 0.25 Sol has been converted into USDC. So in order to close that farming position and return the Sol, you need to buy back this 0.25 Sol. So let's just say in this example, the price of Sol fell by 25%. It went from 200 Sol to 150 per Sol. So in this example, that 0.25 Sol is now worth $37.5. So instead of having to rebuy that Sol for 50 USDC, you're rebuying that Sol at $37.5. So 50 minus 37.5, that's a $12.5 difference between 50 and 37.5. So you can keep that difference between the 50 and 37.5. Francium doesn't care about the price difference. All they want back is the Sol that they lent you. So in this example, the price of Sol fell 25%, but you ended up profiting 12.5% from your position. So effectively, with your 100 USDC, you created a $50 Sol short. So if the price of Sol went to $250, you would be buying back that 0.25 Sol for $75 instead of the initial $50. So effectively you would have lost $25 in that scenario because you initially sold that Sol off for $50 and you have to rebuy it back for $75. So I hope that the calculator and the demonstration I just walked you through helped illuminate exactly what happened there. But if it didn't and you still have questions, you can go ahead and ask them in the comments down below. But I will also write a detailed description of exactly what happened there in the description, so make sure to read that before you comment. But in order to actually go ahead and execute this short strategy, what you need to do is go onto Francium's farm page and then choose whatever token that you want to short. So remember, it has to be from the Francium lend page. So for example, we won't be able to short Cave, Stars, or Allbridge, but let's just choose Sol again. So let's just, there we go, Sol USDC, and we'll have this at 3x leverage. So we press farm and let's do $100 worth. So we'll only be supplying USDC. We have it 3x leverage and the asset to borrow has to be Sol. If it's USDC, you're going leverage long. If it's Sol, you take a short position out. So you can add a stop loss if you want, if you think that you potentially might get liquidated. But yeah, this is basically everything that's set up. So the asset supplied here is 100 USDC. And the assets borrowed is 1.1 Sol. So the total assets in the position is 150 USDC and 0.83 Sol. So that's $150 worth of Sol. In my example, I just used an arbitrary price. The current price of Sol is $177.52. So it's going to be slightly different from my example. So you can press here, you can go on the simulator and it will show you exactly what might occur. But you can also use the calculator tab there as well. And we can just press farm. So what I've done there is I've opened up a $50 short position on Francium, which is 50% of my portfolio. So given current leverage constraints, we can only use 3x leverage. I wasn't able to short the entirety of my portfolio's worth, but I think you might be able to do so on other leverage yield farming platforms out there. Like I think Alpha Finance, for example, on Ethereum, you're able to use up to 9x leverage, but on Francium and Tulip, you're only able to use 3x leverage. So we can see here, if I go into my position details, it shows me what might happen given the price of Sol, where that goes. And then I can go here, I can withdraw everything if I need to. And you can either do it convert to USDC or convert it all into Sol. But let's just say, for example, I just want to withdraw all of my USDC again. I just press withdraw here. Okay, and there we go. I've closed that short position on Francium. So I'll be using the short selling function of Solend here. So they don't have it here natively. It's a trade that you have to structure yourself, and I'll walk you through exactly how it is done. So I'll walk you through it now and talk more about the maths so you can understand exactly what happens, and I'll go through a couple of scenarios so you know what to look out for. So I've got this page up here. Ignore all of this for now, just follow wherever my cursor is. So let's just say you have 100 USDC and you're bearish the SLND token, and you wanted to use a money market to express that short position. So in this example, SLND is worth $4. So each token is $4. Just keep that in mind. So the LTV ratio is 35%. And because you've deposited 100 USDC, you're only able to take out a loan of 35% of that 100. So you're able to take out $35 worth of SLND tokens, which is approximately 8.75, as you can see here. And so the next step is to sell those 8.75 SLND tokens for 35 USDC. And so in order to close your short position, you need to pay back Solend Finance for the SLND tokens that you borrowed. So you're going to need to rebuy those 8.75 SLND tokens. So let's have scenario one, where the price of SLND went from $4 to $2. So that's a 50% drop. So now that value of 8.75 SLND tokens is now worth $17.5 versus the previous $35 it was worth. So we take 35 minus 17.5. That's a $17.5 profit that you have made there, because you have rebought those SLND tokens for $17.5 when you originally sold them for $35. Solend Finance, they don't care the actual dollar value of the SLND that you repay to them. They only care that you give them the exact right amount of SLND tokens that you borrowed. So if you borrowed 8.75 SLND tokens, they expect you to give back 8.75 SLND tokens. Doesn't matter what price they are. So saying that, we'll go into scenario 2. So the price of SLND goes up 10% to $4.4 versus the original price when you took out your short position at $4. So that 8.75 SLND tokens has turned into $38.5 versus the previous $35 that you sold it for. So because you have to rebuy at $38.5 and you sold it at $35, that's a $3.5 loss that you've incurred there. So just to sum this all up, what you've done, you've taken a 100 USDC and then turned it into a $35 SLND short. Now I'm only using SLND here as like an arbitrary example. Any tokens listed here on Solend, you can actually go ahead and short sell. So SLND, Sol, ETH, Bitcoin, MSOL, Serum, FTT, Ray, Saber, and Mercurial Finance. And you don't even have to just purely use Solend Finance itself. So any money market on Solana you can use to do this. In fact, any money market in any DeFi ecosystem you can use to do this. Obviously, you can't short every token. It has to be available to borrow. Rari Capital is quite good if you wanted to do this, because they have Fuse, and in those Fuse pools, like, you can find different pools that allow you to borrow all sorts of different collateral, and then you can sell them off and then return it to the protocol when you feel that your short position has been profitable. I mean, you don't have to be profitable in that short position. You could lose money if you wanted to. I think for the most part, if you're short selling in crypto, it has to be a very short-term move, right? So you will have to repay your loan as well as with interest as well, but hopefully your profit will make up for any of those interest payments that you have to make. So as I showed you before, all you need to do, right, deposit USDC, do that, press supply, and then approve it in your wallet. I've already got USDC here on Solend Finance, so I won't show you that. But now you need to borrow some SLND tokens. So I want to short SLND, so let's just change this to the dollar value. It makes it easier. So I'm going to borrow 8.867. So the price of SLND is $3.95. So it's slightly different from my example here, but the concept is the same, right? You can do this with ETH, for example. You could do this with Bitcoin. You could do this with Sol. You could do this with FTT. So let's do that. I press approve, and then these okay, we can see here assets borrowed, SLND. If I press here, there we go, it's refreshed to 9.21. So in order to actually execute the short position, I now need to go ahead and sell these SLND tokens. So there we go, to Jupiter Aggregator, type in SLND to USDC and sell them all off. So that's $35. I'll swap and then press approve. Cool. Okay, so that USDC is now back into my wallet. So you are subject to liquidation risk when you are borrowing from a money market. Remember, these are all under collateralized loans, so they will liquidate you if you reach the liquidation threshold. So the liquidation threshold, as it says on here, if I go to parameters, the liquidation threshold for SLND tokens is actually going to be 50%, but in practice they've made it 80% for whatever reason here. So I'm going to stick with the 50% because I don't know if this is just out of date or if I borrow too much I'm actually going to get liquidated. So with that USDC, you could go ahead and put it into a money market and start earning yield. I could re-put it back into Solend Finance itself, and that would help me have more of a buffer and help me prevent getting liquidated. But of course, this is something that you have to monitor, like check back 2-3 times a day and make sure the price of Solend doesn't go above your liquidation point. So theoretically, my liquidation point should be $50. So if the value of my borrowed Solend tokens goes up to $50, then I would get liquidated. So if I want to close out my short position, I think I've made a good profit. I need to buy back those SLND tokens. So let me just get those 35 USDC back. Let me just withdraw 36 actually to make sure I get all of it back. And I think this is roughly the amount. So I'd rather overpay than underpay, so I don't have to do this again. Then I can press approve here. Each transaction should go through, and then I go back to Solend Finance. If I press, let's see, okay, the swap's been done. You press refresh again. So I have the SLND back into my wallet here, so let me repay this amount. So it appears I still need to repay 0.1115 SLND, but you get the point, right? Like, hopefully all of that maths worked out and made sense to you in your head.